Hello, and welcome to the 10th episode of the Markets at a Glance series. My name is Rufas Kamau, Markets Analyst at FX Pesa. So as always, we try and cover what's happening in the market, try to understand the key themes, the key trending topics or factors influencing the markets, try to identify some key price levels, and hopefully we build value and everyone gets to benefit from this series. So before I make any progress, I would like to begin with a mic test. So if you can hear me clearly, can you type hi on the live comment section, and these will confirm that everything is working just fine. Hello? Awesome. Thank you for the responses. Hey Daisy, hey Captain, hey Agnes, Nthenge, Christopher. Thank you guys. Thank you for your responses. I think it's time we start right away. So sometimes due to the tech, it's always good to try and confirm that the voice is correct. So if things are working fine, then you proceed. Hello, Marion. Welcome to the session. So let's get this started. So we know that it's a very eventful week. So I think it makes a lot of sense to start with the economic calendar because this is where all the events are recorded. That is a majority of the events that we're expecting this week. So as you can see, on Monday was largely a quiet day, nothing much besides the GDP. So the UK GDP or the gross domestic product was upbeat, better than expected, a 0.5% gain in the last month compared to negative 0.6 contraction in the previous month. So besides this, there is a trade balance, which basically improved from negative 15.4 billion to 14.5 billion. Then the day ended quietly before we moved on to today. So today we have had quite a number of news in the markets. One of them is a German CPI or Consumer Price Index, or basically a measure of inflation, which basically showed that the inflation in Germany has slowed down from 10.4% to 10.0%. So the information is available here on this link. So you click on this link, redirect you, and you'll get more information on the data. So then we had a lot of eventful day as a result of the events happening in the UK. One of the things that we noticed is that there is a claimant count change, or the people who are claiming for unemployment insurance or benefits. In this case, we had a big spike to 30.5K people compared to an expectation of 3.5K. And this was bad news for the UK economy. But more and more people are looking for unemployment benefits. It basically means that there's more and more people who are unemployed. So one of the reasons that this could be happening is the strikes that have been happening in the UK, as well as the UK economy slowdown and so on. Then there's the average earnings. So average earnings index was up 6.1%. However, when you look deeper into the report, you realize that the rise in the average hourly earnings being at 6.1% is still much slower than inflation. So the inflation-adjusted earnings are still to the negative, meaning that incomes in the UK are not rising as fast as inflation. So basically, people are taking a pay cut by living in an economy where inflation is much higher compared to the rate at which their income is increasing. So the unemployment rate was steady at 3.7%, slightly higher than previous month, which was 3.6%. So all these was announced today. So if you look at the chart here, you notice what has been happening in the UK. There was a big spike in unemployment rate to about 5%. And this was in Feb 2021. And then as people started recovering from the COVID-19 restrictions were being removed, then we are back to pre-pandemic lows. So the job market is currently very strong and very resilient in the UK. So the challenges that the UK economy is majorly facing is the rising cost of living. And this is majorly being experienced in energy prices as well as food prices. So people are being forced to spend more on basics. And when I say the basics, I'm talking about food, shelter, energy, and so on, which means they are left with less money to invest and also less money to buy more discretionary products. And this is basically hitting the stock market. So that's one key thing to notice in the early developments of the UK. So there's more news coming up. There's also the Bank of England Financial Stability Report. This was really good. If you have some time, it's very detailed. Basically indicating the report on an assessment of the stability of the UK economy. So I'll try and share the link with you. So there's the link. So if you have some time, you go through the stability report, and then you'll have an understanding of where the UK economy is right now. So some of the key highlights is that the current bank rate is at 3%, and the inflation rate as at last month was 11.1%, which is basically targeted to drop towards 2%. So in this case, we expect the Bank of England to continue raising interest rates in order to push this inflation rate from 11.1 down to 2%. And this is expected to strengthen the pound. So now that we understand that, if you look at the charts and look at the pound and how it has been behaving, then it's quite clear that we have had a good run in the pound, having dropped to multi-year lows at around this level. I remember this was around 1.04. So around 1.03362. 04 was close by. So from here, you can see the strong reversal in the trend. The pound started gaining against the dollar, and this has been a continued theme for the last 3 months. So clearly, you can see the pound has been very strong. Met a resistance here, and this was a high that we saw back in August. Clearly, it seems like the market is attempting to cruise through this high, and then we could see some further upside as we start seeing some policy divergence between the Bank of England and the Federal Reserve Bank of the US. So the Fed has been aggressively hiking interest rates. So since March, you can see the overall trend. So January, February, March, all the way down to August was basically the dollar dominating against the pound. So now inflation is still very high in the UK, but in the US, it's slowing down significantly. So the Fed has more room to reduce the interest rate hikes. So as the Bank of England looks to accelerate tightening in order to control high inflation, the US is slowing down. So this policy divergence has an outcome where we see the pound strengthening against the dollar, and this could be the continued theme for the first quarter of the year. So looking for positions in the direction of that trajectory becomes easy. So you just look for opportunities. When the pound pulls back, go for buying opportunities. So you can already see a theme setting up here, where there is some form of pullback, consolidations, and then after some time, here. All right. So I'm trying to mark this pullback here. So market pulls back and then makes a big pump all the way up. And then another one here, followed by another pump and so on. So anytime the pound pulls back against the dollar, then it has been creating opportunities to buy and enjoy as the market breaks out towards the upper side. So there's a good chance that if we have more positions aligned with the monetary policies of the two economies, then there's a good chance of having more winning positions than losing positions. So I expect the pound to continue gaining strength as long as there's factors that are pushing the Bank of England to continue being aggressive with the interest rate hikes. So that's one of the key things to consider going forward. So let's look at other news in the market. One of them is that German annual inflation rate in November stood at 10.0%. I've already mentioned these. This is a leading indicator of the inflation rate in the Eurozone. So remember, Germany is basically the biggest economy in the Eurozone. There are more economies such as France, you have Italy, Spain, all sharing the same currency. So whenever something is happening in Germany, it's often a leading indicator of what's happening in the overall Eurozone. So if inflation is slightly slowing down from 10.4% in October, 10.0% in November, then there's a chance that it is also slowing down in these other economies. And the ECB might consider this before making the next decision in December. And when I say December, it's actually this week. And all these central banks will be announcing their interest rates on Thursday. So that's the day after tomorrow. So UK inflation data comes out tomorrow at 10 a.m. That's Wednesday. In October, the consumer price index was reading 11.1%. So the analyst estimates for tomorrow is that the UK inflation slows down to 10.9%, which is still significantly higher than the expectation of 2%. So remember the saying we've been saying for quite a good part of this year, that the CPI is the new NFP. So in a couple of years back, when you were trading in the markets, we would majorly take the US non-farm payrolls or the NFP as the biggest event in the market because it would have a huge impact on the volatility as well as the direction of prices. So this seems to have changed over the last 1 year, where the CPI is the one that is majorly moving the prices either in one direction, the other direction, a whipsaw, or anything of that sort. So one thing is clear, whenever there is the US CPI data, then there's a lot of volatility in the market, and prices can jump significantly, creating opportunities as well as risks for persons who are participating in the market. So this is something that we're expecting later at 4:30 p.m. So it's the most important data point for today. It's happening 18 minutes from now. So what markets will be affected by this? So that's something to consider. So I just want to give you a highlight. So 4:30 p.m., looking at the CPI, basically short for consumer price index, or basically a basket of goods and services that are consumed by the average household each and every month. So the price index basically focuses on a key number of items. One of them is housing, the other one is clothing, it looks at food, looks at energy, education, insurance, health, and so on. So when you combine all those units into one basket, then you're able to tell the average cost to the average household in the US. So if this cost is going up, it means there's inflation. If it's going down, then there's deflation. So overall, what has been happening, if you compare this period to period, that is year over year, then you notice that it's costing 7.7% more to buy the same products from last year. So in this case, we're expecting this to slow down 7.3% in November. So if it's better than this, then the Fed might be a little bit more lenient. But if it's worse than 7.3%, that means 7.3% or even higher, then in that case, the Fed might be a little bit more aggressive with the interest rate hikes, and this would be strengthening the dollar further. So if inflation comes at 7.3% or even lower, then the dollar is expected to weaken. And this is the overall reaction I'll be expecting in the market, and this should be 16 minutes from now. So core CPI is basically the same basket of the average commodities that are used by the average household in the US, but this time without food and energy prices, which are considered to be more volatile. So when you remove food and energy prices, then you're able to see these other costs and compare over different periods to see where that is headed. So a lot of investors will be following up on these. We expect the markets to get quite chaotic. So quite a number of things that we'll be expecting. One is gold. Gold could become very volatile. So if you're a gold trader, then this might be the right moment to look for opportunities. The same case, we'll be looking at the S&P 500, the NASDAQ, and the Dow Jones. So remember, the idea is whether the Fed will continue to tighten the market further or whether they will not, they will be more lenient. So further tightening means higher interest rates, which strengthens the dollar and weakens equities. On the other hand, if they are more lenient and they pivot, then in this case, we'll be seeing stronger equities and weaker dollar. So it's a key data points that almost every investor will be following to readjust their position and perhaps enter even new positions. So later on at 1:30 a.m., we'll be looking at the RBA Governor Stephen Lowe. This will be tomorrow, very early in the morning. Then at 10 a.m., we'll be looking at the UK CPI, or the Consumer Price Index. So from 11.1%, we expect the inflation to drop to 10.9%. Then FOMC economic projections, FOMC statement, federal funds rate, and FOMC press conference. So all these will be happening from 10 p.m. to 10:30 p.m. And these causes a lot of volatility in USD currency pairs, as well as gold. We also look at the equities. They can get really volatile. So the overall expectation is that the Fed goes for a 50 basis point hike, moving the US interest rates from 4% to 4.5%. So unemployment change and unemployment rate in Australia. So previous reading 3.4%, we expect this to remain the same with the 19.4K jobs created within the last 1 month. This could also cause volatility in Australian dollar currency pairs. Then later on, in China, fixed asset investment year to date, industrial production, which is very important. We want to know how China is progressing in terms of manufacturing, NBS press conference, and also Chinese retail sales and unemployment rate. So these could also have volatility, especially on with an angle in oil. So whenever China is doing really well in terms of production, it means that it's consuming more oil, which is very positive for oil demand and oil prices. So if China is slowing down, then oil tends to have the negative effect, tends to be going back downwards. So interest rate data from the SNB or the Swiss National Bank will be looking at policy rate, press conference, and monetary policy assessment. And this will be at 11:30 a.m. As you can see, in the previous reading, they hiked to 0.5%. We expect another 50 basis point hike to get the interest rates to 1.0%. So later on, from the UK, vote on official bank rate, basically interest rates. So we'll see the monetary policy summary, and then the official bank rate is expected to be hiked by 50 basis points from 3% to 3.5%. Then for the Eurozone, it's the same thing, interest rate from 2%. We expect 50 basis points to 2.5%, followed by the monetary policy statement. Then in the US, we look at the core retail sales. This will be an important measure to show the strength of the American consumer. Then the Empire State Manufacturing Index to show the conditions of manufacturing in Empire State. Then retail sales month over month. Remember, we have core retail sales and retail sales, quite similar. Then free fed manufacturing, this is in Philadelphia, and also the unemployment claims in the US. So later on at 4:45 p.m., we look at the ACB press conference. This is a big event. Usually causes a lot of volatility in euro currency pair. Then further downwards in the week, we'll be looking at the flash services and manufacturing for the Eurozone, retail sales for the UK, and then flash services and manufacturing PMI for the UK, and then the inflation data for the Eurozone. So in the previous reading, 10.0%, we expect this to remain the same, while core CPI is also expected to remain the same at 5%. So a lot of events will be happening this week, and this could be massive, could cause a lot of volatility. So if you're not a fan of volatility, then you should probably stay out and just watch the market and learn from them. If you enjoy trading in a volatile market, then this is a premium ground for you. So remember to always practice proper risk management, and at the same time, don't forget to learn more, do more research before making your trading decisions. So let's see the key important price points before we conclude the session. So one of them is gold. Gold was largely bearish for the better part of the year. So I can show you these easily. This is on the daily chart. So gold was basically following this particular channel. Sorry. So that's it. So you can see the big spike that happens at the beginning of March. So January and February are largely quiet, and then for the better part of the year, gold was majorly bearish. Then last month, a very strong push upside, and also this month started on a high. And what we are seeing here is a high that was once touched, and this was the highest price that we saw in August. So having hit this high of August, notice the market reversed immediately, pushed back to the same level, found resistance, and the market is now trying to pump to the same level. So if the news in the US indicates some form of strength for the dollar, you can see some further downside in gold. But if there is weakness, then the 1807 price level seems to be the key target level where the market could break and continue moving higher. So we could break this resistance that has lasted since August. So for US oil, it seems like we had a lot of challenges finding a bottom. So having erased all the gains that we had over the year, it seems like oil is trading from a bottom perspective. So if there's good data points this week, then you could see oil finding a very solid bottom at 70 and starting to move further upwards. So on the contrary, you can see what has been happening here. So just clear this, show you clear representation. So this is what we have had over the week, acting as a resistance. So I would say support has been somewhere along these lines. So we can easily say the market has been oscillating between these two lines, going down and then up and then down, up before breaking here. So after the break, market goes up and finds a resistance here, a resistance that was once hit on 8th of December. So just last week. And now we are looking at potential news that could cause volatility in the markets. Of course, if there is a strength in oil, then we get to break this level and perhaps go to the genesis of this trend line here. So perhaps we could see an acceleration all the way up to $77.8 per barrel. Then if the market doesn't behave in that manner, then we are going back down to support. So in this case, a level around $70 per barrel. So the US Tech 100 or the NASDAQ had bounced over the upper trend line. Remember, hadn't quite touched. So we had like 5 straight days of the NASDAQ closing, then went up, down, and then up yesterday and today. So it seems like the bull run is continuing. Perhaps investors will be getting the Santa area after all. So the sell-off that we saw here for 5 consecutive days was very convincing. We were expecting that the SP 500, the NASDAQ, and the Dow would continue moving downwards. However, the pullback we are seeing here seems like a trend pushing back towards the upper trend line. So there's a good chance that we could be seeing these indices vary to the upper trend line. And this is the trend line that has held over the entire year. So 4096 price level for S&P 500. So from the daily chart, if I zoom out, you can already see this started at the beginning of the year. So there's a good chance the market could be retesting this particular trend line before moving further upwards or even further downwards. We don't know yet. So we're just trading the price action and looking for the important price levels. So any questions for me? So good work. Thank you, Dan. Can we look at gold? Yes, we already did that. Dan Tech, good work. Thank you, guys. Thank you for your time and also for your participation. So 1807 seems to be like my key price level for gold if it keeps going up. If it goes back, then this particular low that is for last week of 1732 might be a very important target. So 1807 to the upper side, 1732 towards the lower side. So UK pound seems quite noisy. If you look at the candlesticks, they have long tails, indicating a lot of volatility in the market, but very strong resilience past the upper side. So we don't have a lot of room in this one. So 1.23423, which is basically the high that we saw some days back. So in this case, very short-term target here, expecting the market to retest this area before we make a decision on where the pound is headed next. So one key thing to notice is that the pound had news today, it has news tomorrow, and has news on Thursday. So I will be expecting a lot of volatility in this particular pair. So AUD/USD seems quite resilient, attempting to strengthen further against the dollar. So if I was to move all this clutter and just zoom out the chart, then you can see it's a market that is making a very strong case for recovery. Though the US dollar has attempted to strengthen back, there seems to be seen anything that would break this particular trend line, especially considering that on the other side, we are seemingly having what looks like a wedge. So two trend lines are facing upwards, but they are getting closer to each other. So at some point, we'll be expecting some form of break. The break would be happening to the upper side or to the lower side. So from the forward chart, what I'm seeing here is a market that is trading with a cross-bound range, one on the upper side, the other one on the lower side. So it's all about looking for opportunities on the edges, not in between. So if it gets to this level, then you look for ideas of trading downwards. This side, you look for ideas of trading upwards. So good question. How many pips are there from 1750 to 1751 in gold? So gold is priced in 2 decimal places. So you're basically talking about 10 pips. But why would you be asking about 1751? That's an in-between. I don't see any reason that the fundamentals would just push the price to 1750 around here. There's a much stronger support all the way down at around 1733, 1732, 1733. So if you are talking about these as a short-term target, this would make sense, 1765. But I see a good potential for a run all the way down to 1732. So you're considering that it was a major high here. So a good question. Will the outcome of today's CPI affect the Fed's FOMC decision tomorrow? Yes, absolutely. So when we talk about the decision, remember, tomorrow it's not a unitary event. There's quite a lot of that will be happening in the market. So the number one thing that will be happening is that the FOMC will be voting on an interest rate. So since we practice forward guidance, then there's an overall expectation that the Fed will be hiking by 50 basis points. However, when this happens, we'll be expecting this to be followed up by FOMC press conference. So the press conference is where everything is. This is where they'll be discussing potential policy, the data that they have observed in the economy, how the economy is responding to these rate hikes, and they'll give projections on how much they'll be expecting to hike over the course of the next 1 month. So the outlook will be more important than the print tomorrow. So when you follow the outlook, then you're able to make decisions on the direction of the S&P 500, NASDAQ, the Dow Jones, as well as the US dollar pairs and the direction that they'll be taking. So thank you very much, guys. I hope to see you on the next session. So enjoy trading the news announcement. I think it's airing in the next 1 minute. So I will allow you time to focus on the markets. And if there are opportunities for you to trade, then go and take advantage of those opportunities.